Hey guys! Welcome to episode 5 of our 10-minute bookkeeping series. Today, we're turning our attention to expenses, a crucial part of accounting that keeps the financial gears turning. We'll leave no stone unturned in understanding how to recognize regular expenses and delve into a unique category of expenses called losses. We'll wrap up these 2 episodes learning with the concept called accrual accounting, which showcases the solid basis of modern accounting language. So, without further ado, let's get started right away. Expenses should be recognized as soon as consumption takes place. Why? Well, accounting is a conservative language that won't take risks with inflating net income. So, when resources start flowing out of business operations, accounting doesn't procrastinate. It swiftly marks that as an expense, avoiding any delay in presenting an accurate financial picture. Expenses can be a bit tricky to deal with, especially when they occur daily. That's where our trusty tool, end-of-period adjustment, comes into play. It helps us record expenses at the end of each accounting period, based on how much has been consumed during that time. Just like revenues, expenses are tied to consumption, not just the flow of cash. You can recognize expenses before, after, or when the cash actually changes hands. Let's kick things off with the simplest scenario, the pay now, consume now situation. Imagine this. On January 27th, the Nova company paid $1,500 for advertisements running in January. The expense is related to advertisements, so it's known as the advertising expense. Now, it's your turn to dive into the action. Pause the video and give this transaction a shot. In this transaction, Nova paid cash to consume the advertising service, so we should recognize the expense while reducing the cash balance. It's a double entry dance, with a debit for the advertising expense and a credit for cash. Sometimes an entity pays upfront for a product or service, but uses it at a later date. This is a common scenario, and to account for it, we have special accounts called prepaid expenses. These prepaid expenses are assets to the entity because they bring future benefits. For instance, when an entity pays for insurance in advance of actually receiving coverage, it's known as prepaid insurance. Similarly, we have prepaid rents, prepaid advertising, and prepaid promotions, all of which are assets because they provide benefits in the future. Let's put this concept into action with an example. On March 9th, Nova prepaid $3,000 for insurance coverage that extended for 3 months, from April to June. How should we record these transactions? Here are your hints. Nova prepares financial statements monthly, so we should recognize an expense at the end of each month. And the expense associated with consuming insurance is called insurance expense. Take a moment to pause the video and give it a try. Welcome back. On March 9th, Nova prepaid $3,000 for 3 months of insurance. To record this, we debit prepaid insurance and credit cash. From April to June, Nova gradually consumed the insurance protection. The monthly consumption? $1,000. So, at the end of each month, we debit insurance expense and credit prepaid insurance. But that's not all. Entities can also chomp through other non-cash assets. Let's switch gears and look at a new example. On June 1st, the Nova company paid $3,000 to acquire some inventories. On July 10, it delivered inventory costing $1,000 to customers and received $2,000 in cash for the sales. In this case, Nova consumed its inventory to generate revenue. This expense is directly linked to sales and is called the cost of sales. Now, it's your turn again. Pause the video and make journal entries to record these transactions. Now let's walk through it together. For the transaction on June 1st, cash decreased and inventories increased. Both of these are assets, so we debit cash and credit inventories. Revenues should be recognized at the time of delivery to customers. So on July 10th, we should debit cash and credit sales revenue. At the same time, inventories were consumed by Nova, directly related to the sales. So we recognize the cost of sales with a decrease in inventories. And now let's talk about the last scenario. An entity can enjoy or use a product or service immediately, but the payment for it is deferred to a later date. In this way, the expenses are recognized with an increase in liabilities. Now picture this. Nova's hardworking employees dedicated their time and effort throughout August, earning a total of $100,000 in salaries. But they had to wait until September 10th to get their paychecks. Your challenge? Take a moment to record these transactions. Welcome back. In August, Nova's employees poured their heart and soul into their work. The company benefited from their efforts. And as August came to a close, it was time to recognize the related expense. But the expense hadn't been paid, so it should be recorded as an obligation to pay salaries, known as salary payable. On September 10th, Nova handed out the paychecks. The company's cash decreased with a decrease in liability. To capture this, we debit salary payable and credit cash. Now you've got a solid grip on all these scenarios for recognizing expenses. Remember, every bit of consumption comes with a price tag. Some hit an entity's cash immediately. Some eat into other resources like inventories or prepaid expenses. And some add to its list of responsibilities. But the bottom line is simple. Expenses reflect the resources a company consumes. When consumption happens, an expense should be recognized. All right, now let's move on to the next section. Expenses in accounting are typically routine and expected, but there's a special category known as a loss. These are like unexpected curveballs that can hit an entity. Losses occur due to infrequent events such as fires, lawsuits, or selling long-term assets. If there's even a reasonable chance that a loss might occur, even if it's not certain, it should be recorded. Let's take an example. On December 11th, a customer filed a lawsuit against Nova, seeking $2,000 in compensation. At the end of December, the lawsuit hadn't been settled, but it seemed reasonably possible that Nova might end up on the losing side. In this case, we should recognize a loss at the end of December, and that comes with an increase in the provision for liability, which implies the amount of the liability is estimated. Once again, we can see that accounting is a conservative language. It avoids any chance of overstating an entity's net income. So when it comes to revenues, accounting waits for the delivery moment, but when it comes to expenses, accounting records them as soon as possible. Even unexpected curveballs are accounted for promptly. Now let's wrap up today's episode with the concept called accrual accounting. In Episode 4 and this episode, we've unlocked the secrets of recognizing revenues and expenses. Revenues get recognized at the moment of product delivery. Expenses get recognized when there is resource consumption. This recognition method is known as the accrual basis, the cornerstone of the modern accounting language. But hold on. There's another player in the game, cash basis. In the cash basis, revenues are recognized when cash flows in, and expenses are recorded when cash flows out. However, the big leagues of accounting prefer the accrual basis for its precision. Now, let's solidify our understanding with a practical example. Meet the Gram, a company specializing in consulting business. In January, it got $6,000 for 3 months of consulting, from January to March. Gram also paid $3,000 for insurance, covering it for the same 3 months. If Gram prepares financial statements monthly using accrual accounting, it would recognize $2,000 in revenue over January, February, and March. Simultaneously, it had spread $1,000 of the insurance expense across the same period. The result? A net income of $1,000 for each of those 3 months. But what if Gram used the cash basis accounting? In January, its income statement would have a $6,000 revenue and a $3,000 insurance expense, giving it a net income of $3,000 for that month. However, February and March would have no revenues or expenses to report. The difference? Accrual accounting paints a detailed picture of what Gram accomplished over 3 months, while the cash basis is just a 1-month track of their cash flow. That's why we prefer the accrual method. It gives us a full understanding of an entity's performance. Congratulations. Now, you've not only learned how to recognize revenues and expenses, but also gained a solid understanding of why we're doing so. This will propel you much further in the journey of bookkeeping. But don't hit the brakes just yet. Go ahead, finish the exercise. And I'm looking forward to seeing you in the next episode.